So welcome everyone back to our bi-weekly meeting of American Union Economics. Happy to be here today with Brian Winters, Josh Sidman, and TC Townsend. And today we will talk a bit about the theory behind the economics of UBI, something I call capital consumption theory. And if we have time, maybe we'll talk about the global savings glut. So let me go ahead and share a couple things. So from the blueprint for a better America, welfare has a specific definition: the state of being or doing well, condition of health, happiness, and comfort, well-being, prosperity. The constitutional duty to promote this can be best met with universal basic income. Under this legislation, approximately 300 million citizens would get an unconditional American Union job, a no strings attached reminder of our constitutional duties to each other, and as a compensation for the value that all Americans create. So we're talking about in the blueprint a UBI of $1,300 a month for adults, $433 a month for children, paid with Treasury dollar bills, legal tender issued by the US Treasury. So I'll do a quick run over of, sort of the basic theory. So, we can ask questions: what would be the effects of instituting a universal basic income? Would it increase prosperity and eliminate poverty? Would UBA result in inflation, which is a big question that comes up over and over again?
Well, it comes up especially right now, right? People, again, we're doing text banking, asking people about UBI, and a lot of them are like, no, that's going to make inflation worse.
About 6 months, six or 9 months ago, I was sending DMs to Scott Santens because I noticed that at the time a lot of people on the left were saying, don't worry about inflation, inflation's not a problem, it's propaganda, it's just the pandemic, they were saying at the time. And I was pointing out and saying that we really should examine the potential for inflation, scientifically, not let it be political. I mean, if you let it be a political thing where the left is saying there's not going to be inflation, and then you get inflation, then that is going to discredit the left for having said that. And if you examine it, you'll find that we have inflation that we have is very, very interesting. It's different from what we had in the 70s, and it's what I call low utilization type 2 inflation. But let me go ahead and start from the beginning. So, if we talk about Keynesian theory, which is sort of the standard of most economics, the basic, in a very simplified nutshell, the basic idea is that if you have too little stimulus, then the economy kind of you can get an economic downturn. If you have too much stimulus, you can get inflation. So you would want to ask, how do you determine how much stimulus is too much? Can you have, what is the if you are going to have a scientific model about how this works, then the scientific model should have, stimulus is a variable, inflation is a variable, and growth is a variable. And the model should tell you how these are related to each other, mathematically. What is the cause and effect? What is the relationship? And from that, from a, I would think from a well-defined model, you should be able to say, based on, the indicators of this economy, this is how much stimulus that you need. So I also ask a question: can you have both problems at the same time? Again, we're talking about two different variables here. So you have inflation on the one hand and growth on the other hand. And I guess the premise of most economists is that these two are basically a trade-off. So, you can have, sort of, um, sort of like a Goldilocks theory, like you want to get it just right. But if it's too hot, the idea is that you'll get inflation; too cold, you'll get a downturn. But based on the fact that these are two different value variables here, is it possible to have both problems at the same time, or say neither problems, and why? Why would that occur? Um, so the sort of the standard idea about inflation is occurs when demand overwhelms productive capacity. So that makes, I think that the um, demand overwhelming productive capacity, that causing inflation, that does sort of make sense from that seems to be a coherent idea. So then you should probably ask, how do you measure capacity, and how do you measure capacity utilization? So it turns out that the St. Louis Fed actually puts out a measure of capacity utilization, going back to 1960 something. This is the measure. And it's very interesting. I'll point out a couple of things. One thing is that, these areas shaded in gray here, these are recessions. So, 2007, the, GFC, 2000, post 2000, the tech bubble crashing, early 1990, all of these gray areas are the recessions. And you can actually see this recessions very clearly in the chart of capacity utilization. It's very obvious that during the recessions, there's very clear short-term downwards movement of capacity utilization. So that's interesting. And another thing
so why is that exactly, right? So the recession is people stop spending money and
yeah,
they save their money instead of spending it. And
yes,
so therefore not many goods and services are produced to in the economy.
yeah,
And
absolutely.
so
Yeah.
does that then lead to deflation during a recession?
During any of these times, during the last 50 years, that has not tended to lead to deflation, although it has tended to sort of um, relieve inflationary pressures a little bit. So Brian, in one of our episodes, we looked at inflation. If you look at a chart of inflation and compare these two charts, and what goes on, and what you have with inflation is from about in the 1980s to really 2020, really up until pre-pandemic. These 30 years or so is basically just low inflation. It goes up and down a little bit, but it's quite low. Towards the end, in the 70s and towards the end, like during the actual recessions, there tends to be sort of a little bit of a drawback in inflation, but the long-term trend of inflation looks very different from
So if the traditional
inflation.
theory is that when inflation is a result of demand outstripping the capacity,
Yeah,
right? So that if the capacity falls, uh, or yeah, so if production falls, then maybe I got
yeah.
it backwards.
So
Shouldn't that lead to deflation?
Um, you might think that, but the data does not show that low capacity utilization leads to deflation. We've had essentially no deflation in the last 20, 30 years. And capacity utilization, this downward trend is actually towards century lows. So prior to the Great Depression, we were also around 70%. And during the Great Depression, we fell into the 60s. So we're basically around the same level as, circa Great Depression times. And, when we say that high demand, overwhelming productive capacity will cause inflation, I would argue that the mechanism for that is, if you think about it, it's quite intuitive. Um, if businesses are sort of at capacity, if you imagine all the businesses in the economy are very close to producing as much as they can with the factories that they have, that their factories are running full out. This is the capacity of the factory. That's how much can be produced, and then you manage to get demand continuing to rise above that ceiling, and the consumer is trying to spend and buy basically more production than the economy, the factories can actually produce, then it would make sense that you would get some inflation. So if you look at what the business owner would see, microeconomically, in that situation, what they would see is that, their factories full out. They've got extra orders coming in. They've got more orders than they can actually deal with, and they're having to turn customers away because they cannot produce more. And in that type of situation, it would make a lot of sense. The business owner would say, okay, I can't take care of everybody. I might as well raise the prices, say 10%, and basically, get rid of the 10% least motivated buyers. And my factory would still be completely full, full out. The volume would stay the same. And if I, if I increase the prices 10%, then that is very, very profitable. When you get to the level where um, the capacity is fully utilized, it does make sense that businesses will say, since we're already fully utilized, it makes a lot of sense for us to raise prices, because we'll stay, if we're bumping past that number, then we can keep our volume up and make larger profits. And that is indeed what you see, is that during the time of highest capacity utilization, the 1970s, this is the time of high inflation. If you look back to the 1960s, it's actually a steady rise. As capacity utilization goes up in the 60s, inflation is already going up. So during the 60s, inflation is already at 3%, 4%, 5%. It's actually a very steady rise, and it matches capacity utilization very well. And then what happens is that after 1980, you have this drop in capacity utilization, and at the same time, inflation goes away. And at the time, nobody really expected that. They were still worried about inflation, and it just went away, after 1980, and essentially never came back for 30 years. So capacity utilization would sort of give you a hint, like you might think, that actually makes sense, because capacity utilization went below 85%, and it never came back. It never went above 85%. And so the business owners, never got to that point where they were fully, utilized. So, they never had those pressures in this 30 years. So capital consumption theory, one of the one of the bases of capital consumption theory is control theory, the idea of feedback loops. This is a feedback loop from control theory. They use it a lot in engineering, and it's fairly well understood. And just an example that most people are familiar with of a negative feedback loop is, say, a thermostat. So with this thermostat, you have a heating element and a measuring element, a thermometer, basically. And then you set it at a certain temperature, say it's 70 degrees. Okay. And it's cold outside, it's winter, so naturally the temperature is going to tend to go down. And what the thermostat does is that when it goes down past your set temperature, it finds that it is no longer at the set temperature, then it will turn on the heating element. So the heating element will heat up the room, and the temperature will go back up. So a downwards movement in the temperature causes an action, which causes the temperature to go back up. Eventually, it goes up past the set temperature of 70 degrees, and then the thermostat measures that and tells the heating element to turn off again. Okay, stop heating the room. Okay, so then it goes up. So it goes down, goes up, and then it's winter, so it starts to cool down again a little bit, and then eventually it gets cold enough so that thermostat registers it, turns on the heating element again. So you get this sort of zigzag back and forth within like a narrow range close to the set temperature of 70 degrees. This occurs in biology a lot. Negative feedback loops, where a change in an output causes something to cause the output to change in the opposite direction, lead to stability. A positive feedback loop is the opposite type of thing, where a change in the output causes the output to change even more. So an example is a fire. So if you have a big stack of fuel, like a bonfire, and you set a small part of it, on fire, you start off with a small fire. small fire heats up, the materials nearby, and those catch on fire, and then that causes more heat, and pretty soon you start with from one small corner, you will get the entire stack, burning at a high rate with a lot of heat. That is a positive feedback loop. It's a self-reinforcing condition. So going viral, in the last decade, this has become sort of common knowledge. Like everybody younger than a certain age knows about going viral. Where you're sharing something on social media, and then people see it, share it with 3 more people. Okay, and
All right.
those 3 more people, they each share it with 3 more people.
So how does this
Soon,
relate
like
to
the whole
UBI?
world has seen this. So this relates to UBI because, and I just want to say that positive feedback loops can operate in 2 methods: growth or stagnation. So sometimes, like if you're pouring water on the fire, and then you don't have that fire, then you can have stagnation, where because you don't have fire, nothing catches on fire. So you're going to continue to not have fire. Or, if something's not going viral, like people are not sharing it, then that's just going to continue. Wealth accumulation is similar. And this relates to UBI because of the wage spending feedback loop. The wage spending feedback loop. So here's the wage spending feedback loop. If we think of the economy as a partially automated factory, wages, we have labor here. The consumer worker is providing labor and receiving labor income, and they're taking their labor income and they're spending it in the economy to buy the economic output. So that's a positive feedback loop. So if you imagine that the labor income goes up for whatever reason, that's going to put more money in the hands of the consumer worker. So they're going to be able to spend more. And one of the consequences of the consumer workers spending more is that there's going to be more demand for labor. So if you go to more restaurants, if you buy more clothes, whatever you buy in the economy, all types of widgets, generally speaking, they require some labor input to be provided. And so the more spending you have, the more labor demand you will have, which will tend to also raise labor income, either through employment or through causing the wages to be bid upwards when demand gets tight. When the economy is trying to find more labor, and the prices are getting bid up, then people will tend to migrate towards the highest wage job available. So this is a positive feedback loop. And a positive feedback loop can occur in two types of modes. One is a growth mode, and one is also a stagnation mode. So if labor income is stagnant, that will tend to cause consumer spending to continue to be stagnant, which will cause labor income to continue to be stagnant. So that's sort of like our fire, never getting anywhere because it doesn't start anywhere, or our tweet because it's not sufficiently hot. It never goes viral. So if it doesn't go viral on the first day, it probably doesn't on the second day, on the third day, etc. So the positive feedback loop, the growth mode, is the hypothesis is that the growth mode occurs between the Great Depression to 1970. You have a growth mode where labor income is rising, consumer spending is rising. You end up with production rising, you end up with productivity also rising, which makes sense when you have high and rising wages, and you have capacity utilization going up. So it's not in this chart, and my numbers on capacity utilization from Great Depression come from Ray Dalio, from his data. His data is simply around Great Depression. He probably has more data, but what ended up in his published book was Great Depression, 70s, 60s, dropping into the 60s. And then from the Great Depression in 1970, you have you would assume that you have a trend, an upwards trend. And then we have, very, detailed data here from the 1970s to the 2020s. So this is a stagnation mode where labor income is stagnating, spending is stagnating. And the result of that is that the utilization is going to go down. The factory is going to not be as busy if the consumer doesn't have that much, more money to spend, and that will also cause labor demand and labor income to stagnate, and which famously is true from 1970s to the current era. Basic wages of your, like say, a basic factory worker who's not a manager, in the company has been stagnant for 50 years. And that is during a period of time where the economy has grown, I think, around 4 to 5-fold between 1970 in the last 50 years. So you have an enormous growth in the economy, and the basic wages are absolutely flat. And you also have, symptoms of low utilization. So, measured by the St. Louis Fed, capacity utilization is very low, century lows. And another thing that happens is that you tend to have what I will call a capital consumption imbalance. So normally in a healthy economy, the capitalist makes money based on their ownership of the factory. And in a healthy economy, the capitalists will tend to take that income and they will invest it back into more factories. So they make lots of money with the first factory, and then they're going to make more factories, is normally what a capitalist does. But if you're in this stagnation mode of the consumer worker, where the consumer's income is already strapped and they cannot afford to buy more stuff, then when the capitalist goes to consider about building a new factory, he will take some measurements. One of the things he'll look at is that the current factory that he already owns, he's going to find that the utilization is quite low. It's not being fully used. So then he says, why do I need to build more factories? I can't even use the ones that I already have. Same thing with.
So one of the ways that we've been making up this gap since the 1970s, right, is through consumer debt and credit
Yes,
cards.
absolutely.
And their wages aren't going up; they're just borrowing the money.
Yeah, absolutely.
To buy this increased capacity.
Yeah,
But so a better way is UBI, right?
A better way is UBI. The debt is long-term unsustainable, especially for the consumer, because the consumer borrows at about 20% on their credit card, and it's not sustainable, and they're generally not purchasing assets, so it is not ultimately sustainable. The only way that can sustain for a limited period of time is for credit limits to go up. So actually in the 70s, and I think Great Depression early on, you actually have very little consumer debt. And so consumer debt is a bit of a normal thing, is a bit of a thing that is growing, and it's become larger. Another part is real estate debt. So you end up funding lots of real estate. Famously, America has very big, very large houses. And that's one of the only ways that most people can access debt, is by buying real estate. So you end up with lots of maybe it's sort of malinvestment in real estate. Yeah, so that's the basic idea.
So wouldn't higher wages, though? I see your conclusion down there that
Yeah.
UBI would result in higher wages.
Yes.
Wouldn't that also contribute to inflation? Or is the goal that higher wages would also drive increased productivity? Right, the way that McDonald's would replace some of its workers with kiosks, but then pay the remaining ones more.
So if you think about wages as an input cost, wages are an input cost, and so are many other things. So are raw materials, so is capital. There's many different input costs to economic output. And unfortunately, economists sort of glommed on to this this idea of a wage cost spiral, and you can see how that is actually I think that is maybe relevant to the 70s, that when you're in this overall place in the economy that's resulting in inflation, then as cost of living goes up, then the workers will demand more wages, and that's normal. But generally speaking, it is not always the case that inflation goes up because wages go up. That is an assumption that you definitely do not want to make. People who make that assumption in the current era are incorrect, completely incorrect, because the data tells you that real wages in the current era are actually going down as your inflation is going up. So it cannot possibly be that. So that hypothesis where you say, inflation is caused by wages, is disproved in the current era, because
Well,
if
I
you
mean,
think
but
that is caused by wages, then conversely, a decrease in real wages should actually be a relief of cost pressures, and it should actually drive us towards deflation rather than inflation.
well, anybody who says inflation is caused by just one thing obviously is wrong, right? There's a lot of contributing factors.
There's a lot of contributing factors, but here's the thing. So on the one hand, you don't want to oversimplify and say it's just this one thing and be clearly wrong. On the other hand, you don't want to go into sort of theoretical nihilism and say that, oh, there are many factors. So, and at the end of the day, who knows? Because there's 10 different factors that point in different directions. Okay, so who knows what's going to happen? What you want is to, out of all the different factors, you want to select out the ones that are relevant. You want to have a clear causal mechanism why this causes what and how much of it. And so the inflation that we currently have, the CCT theory is that this is type 2 inflation. It occurs during periods of low utilization and high wealth inequality. And that's true of like famously Zimbabwe. Weimar had very high income inequality. And one of the things that happens is that if you have, the income, you have income inequality because labor, has been labor income has been sort of stagnant for 40 years, and so the income is pulling up here with the capitalists, and they actually have very little to, they can't figure out what to invest in. That actually drives asset prices up. So when you have a high income inequality, which empirically we have that right now, one of the things is that the demand curve is going to get steeper, because the people who have, lots of income, the, top 10%, 20%, if you raise prices on them, they will be able to afford to rate to the higher price. But the more unequal you get, there's going to be more and more people on the bottom who are unable to afford your product in the first place anyways. So they were never your customer. So if you raise prices, it doesn't matter because they couldn't afford the product in the first place. So you'll end up with businesses finding that when they raise prices, the volume that they sell does not go down very much. It goes down, but it doesn't go down very much. And empirically, in the last year or so, Charlie Munger talked about this, how, because Charlie Munger owns, a portion of many businesses in America, large chunk of, the economic sector. And he was telling his, investors that his managers of his businesses were telling him that generally they had lots of capacity, but because of the worry about inflation, they were raising their prices, and they were finding that when they raised their prices, the markets could sort of sustain that price. Like when they raised the prices, volume didn't go way down. Because if your price goes up, if you raise your price, but then volume goes way down, then you've sort of hurt yourself. But if you raise your price and the volume doesn't go down very much, then you'll find that that's very profitable. And that's what they found. And empirically, that is also what we have found in the last year throughout the business sector, is that profits are way up. And there's sort of a political discussion of I think including like Elizabeth Warren, certain members of the progressive left are saying, it's business's fault. It's because they're greedy and they're raising prices. I don't entirely disagree with all of that, but I would say that greed is not a changing variable here. So it does not explain why we have inflation now and not 3 years ago. But what does explain why we're having inflation now is that income inequality is getting higher and higher. There wasn't a narrative of inflation, and businesses started raising their prices. And when they did that, they found that it was profitable, and the volume did not go down very much. So this is in my theory, this is type 2.
Well, all these things are contributing factors to inflation, right? Is the size of the money supply, the workers' wages, prices of commodities or shortages of commodities, and greed, right? And so
I would generally say they're not in every area. They're not. I would generally say most of them are not contributing factors. They have a little bit of influence, but not very much. but the driving factors in type 2 inflation is two things: high demand inequality, high demand inelasticity, and asset bubbles, and inflation narrative. Those drive type 2. Type 1 inflation is driven simply by demand. So if you look at our positive feedback loop here, from 1940 to 1970, demand is going higher and higher because of the positive feedback loop, and capacity utilization keeps going up. And then when it reaches the ceiling, then you have that effect of capacity constrained inflation, where businesses are saying, I'm going to raise my prices because I can't keep up with my orders anyways. So it makes a lot of sense to raise. Those are the only factors. Everything else is just noise. In type 1, it's just because of high utilization. Type 2 is just mainly because of demand inelasticity. And the other parts are like sort of, they're, I don't know, they make a small difference, but they don't drive the change.
So would you say type 2 is greed driven?
No, I would not say type 2 is greed driven. I would say that greed is a constant factor, which is not particularly useful. It's not indicative, it's not predictive, and it is also not an effective lever. There's no lever that you can change to make people more greedy or less greedy. I mean, maybe like if you're, Gandhi or
the type 2 inflation you're talking about is when businesses raise their prices, knowing that they're going to lose customers, but that they're still going to be more profitable even though they've lost customers. That they're willfully reducing their production in order to make more profits. And so why wouldn't you call that greed?
Because the thing is that if you provide a UBI and you provide sufficient income to the consumer worker and you don't have this inequality, then they would not be motivated to do that. They would still be motivated by profit, and the profit motivation would cause them to keep prices low or even lower them in order to expand volume so that they can actually keep their factories busy and running. So in Alaska, every year when they have the dividend come out, all the businesses have this enormous sale. Everybody has money in their hands, and rather than, the sort of standard Keynesian thing of businesses going, oh, look, lots of money, we better raise our prices. They do the opposite. They have a big sale. And it makes sense that they have a big sale, because when everybody has money in their hands, it makes sense to try to capture as much of that as possible. And when you do that, that is profitable, especially when your utilization is not at the ceiling in the first place. I think that Josh, I think I saw your hand go up.
Yeah, I was just going to sort of play devil's advocate and ask you. I don't quite buy the notion that these are the only two reasons for inflation, and so I was going to play devil's advocate and ask you which of these two factors do you think caused the hyperinflation in Weimar Germany?
Type 2, absolutely type 2. So if you look at Weimar Germany, I've always been looking for utilization figures, and I haven't been able to find that, but I have found inequality figures, and unsurprisingly, so you have a theory. The theory makes predictions, and you check it with data. And type 2 inflation would the prediction is high inequality, and that is absolutely what you find in Weimar Germany. Is that it was a very unequal society. It was sort of the last gasp of you had the aristocratic class, and it was very unequal. So that is part of it. Another part, there's many, and then there are the other symptoms that are similar. So Weimar Germany, one of the things that they dealt with was sort of asset bubbles and stock speculation. Anecdotally, during the periods of especially the period of like 1931, if I remember correctly, there was actually a period in 1931, there was actually a year where they had been having, sort of inflation on and off since World War One. But, in 1931, it actually, came down a bit, and stock prices went way up. So they had enormous asset bubbles, just as we do today. And asset bubbles are, also makes sense in this context that, when you have low utilization, high inequality and low utilization, then what happens is the capitalists, normally they're trying to invest their money into productive capacity. But because productive capacity is no longer investable because of under demand, that financial capital tends to actually back up. And so if you look at this market here between a real investment and financial capital, which is searching for something to invest in, what happens is that this pulls up and the rate of return goes down. And the rate of return, the market rate of return is the inverse of the market valuation of an asset. Okay, so it's a little bit like bonds. So if if the market rate of returns on bonds is 2%, then theoretically, when you look at bonds that were issued, like 10 years ago, so they're at 5%, the market will value them at that same rate. And what it will do, it will basically cause the bond to be worth more. And you can sell the bond for more than its nominal value because the income is now worth more in a 2% environment than in a 5% environment. With stocks, the PE ratio is essentially a market, more or less a market rate of return, but the PE doesn't account for growth. But it's a similar idea. The lower the market rate of return, the lower the earnings yield that you require on a company, then the higher is going to be the price of that company. So you also have asset bubbles. And what else do you have?
Well, all right. So, but going back to Weimar Germany, right? This is right at the end of World War I.
Yes.
So a lot of their productive capacity had been destroyed, damaged, whatever during the war, and they were purposely running, shooting for moderate high inflation.
So that's
doing that. So wouldn't their productive capacity have been, right up near nice and high? Wouldn't you think? I don't know.
So
Josh,
I wish I had data on the capacity utilization, because I have a prediction here, and I would love to be able to test it. I haven't found that data, but the idea that capacity was destroyed, and that was one of the reasons. Most of the war actually occurred on the. If I remember correctly, there was also a lot of damage in France. And if you compare like sort of different countries that had, levels of capacity destruction, not all of them had hyperinflation. So that is a potentially a hypothesis that it is caused by the destruction of capacity. But I would argue that is not supported by evidence or data. And there are very little. If you really wanted to examine that hypothesis, you could go around and look at all the cases in history where you had a lot of destruction, and did they result in hyperinflation? I think a lot of them did not, but for all of the cases of hyperinflation that I looked for, so we don't have data for Weimar Germany. We do have data for Zimbabwe. And Zimbabwe in capacity utilization is actually very low. And we have data for Argentina. We've looked at that together. And it does, the opposite of what the standard idea of, inflation does, which is that, the standard idea is that when you have high capacity, high utilization, that causes inflation. But Argentina does basically the opposite. Argentina.
Josh, what were your thoughts on Weimar Germany and inflation?
The reason why I asked the question is because I think that the answer is fairly well agreed upon, and that it is neither of what we're talking about here. The hyperinflation in Weimar Germany, as I understand it, took place in the course of about 1 year, and it is attributed by everyone who I've ever heard opine on it to massive war reparations imposed by the victors in World War I, and the simple mathematical inability of the government to pay those reparations. So, So the reason for asking the question was not to challenge the legitimacy of your explanations for, standard, the standard ebb and flow of inflation, because the hyperinflation in Germany was very non-standard. It was a very anomalous situation. But the purpose of the question was to kind of support what Brian said, which is that I think nowadays everyone is trying to explain inflation, and they're trying to come up with simple, elegant, easily understood explanations. And I just don't think that's how things work in the real economy. I think that there are many different reasons why inflation can occur. And I don't think that either of the two varieties that you are describing capture, a significant portion of the causes of the Weimar example. And so that's just the purpose of the question, was to support the notion that there are no simple catch-all answers to a very complex real world phenomenon.
Yeah, I agree. I agree that the real world is complex and difficult to understand and difficult to predict. And if you're talking about an economy which has just very large numbers of people, different narratives, different groups of actors, it's going to be complex. And I think that I think it was Albert Einstein that said, a model should be as simple as possible and no simpler. So it should definitely not be so simple that it doesn't match the data, but it should also not be, it should be as simple as possible while still predicting the data, and not resort to, sort of sort of complexity which does not add to the predictivity of the model. It's a trap that I think a lot of economists will go into that area and say, this is very complex, and if you are sort of modelless and you don't have like a very clear, strong model of how inflation happens, then what's going to happen in the real world is that inflation is going to go up, and then you're going to look around and you're going to say, oh well, this happened before inflation came up, so it's probably this, and then it goes up some more, and then something else happens. For example, the war in Ukraine happens, and then you say, oh look, we've got the war in Ukraine. I bet that has to do with inflation. It sort of makes sense, and the timing is very convenient, because after the inflation happened, then you're constantly looking for reasons why it's happening. And so because there are infinite potential reasons, then you're going to find them. But if you look at the data, the inflation rates, if your hypothesis that it's caused by the war in Ukraine, then you would expect a certain thing. That you have inflation, that the war of Ukraine hits, and then it goes bam, way up, and then after the war is over, you will expect the inflation to come down, because it's no longer you no longer have the war. My point is that we should generally look at the data and see if those hypotheses match. Based on the hypothesis that is the reason, then you should make a prediction about what you would see in the inflation data, and then see if it matches. This is Argentina. So capacity utilization, the standard, let's see, 10 years, 10 years. So the standard thing where, high utilization causes inflation means that you would expect that you get high utilization, and then you start getting inflation, then utilization stays high as you get inflation. So if we look at inflation in Argentina, it is relatively low prior to 2014 for the area. 10% is not super high for them. From 2014 goes up and up and up, and we're now at 60% per year. 8 years in Argentina. That's fairly high right now. And so again, the prediction is capacity utilization goes up, it reaches a ceiling, and it's bumping along the ceiling, and that's why you're getting inflation. What you see in the data is actually the opposite. 2014, remember, is when inflation starts. And when inflation starts, utilization goes down, and it goes down more or less continually up until the current period. As inflation is going up, utilization is going down. That makes absolutely no sense with type 1, which is basically the standard. The standard idea is basically the economy is too hot, utilization is too high, and the data is the exact opposite. And the data fits the type 2 story that, businesses are raising prices, their utilization is going down as a result, but they, in this type of situation, they make more money by raising those prices than otherwise. So Weimar Germany, again, Weimar Germany is very, very interesting. And it's worth looking at those that period of history. And I've spent quite a bit of time looking at that stuff in detail. And the reparations are an enormous drain on government resources during that time. So you definitely have this sort of like enormous, very difficult to avoid spending requirement for Germany at the time. But if you look at the details of the narrative of what goes on,
about that. So what were they paying the reparations in? Do you know?
They were required in gold basically, in gold marks, which is basically gold. Yeah.
So I guess like the sort of the scenario today, like, so if when we snap our fingers and send $40 billion in aid to Ukraine, right?
Yes.
Like if that money goes over there, then why or how would it impact prices in America? Right. So if they're sending reparations out of the country, how does that impact prices in Germany?
Yeah. That's a good question. So if
anybody else have any ideas?
So Ray Dalio, he has a book, a free ebook called like big debt cycles, and he has like an entire section on the Weimar section, and it's a bit long to go over. It's a bit longer than we probably have time to go over today. So I'm trying to think of what are the core things. The core thing is that so one of the aspects of Weimar Germany and of the US right now also is a mismatch between spending and revenues, right? So you would think that if a government is able to receive as much revenues as they're spending, then they're going to be okay, right? And if spending goes way up and you match it with revenue that goes way up, I would argue that would also be sustainable. So you have countries in Europe, you had America during some periods of its history where the tax rate was as high as 90%. You can raise, generally speaking, you can raise more taxes. And if you can raise taxes to fund the spending, then you'll probably be okay. So a large increase in spending is definitely going to be a sort of a pressure on your government. And it wasn't just the reparations. The war itself was also like a high level of spending. And during the war, what the government did was, the first thing they did was they borrowed money. They issued war bonds, but it was basically not enough. And public subscription, like the investors stopped buying the war bonds. And so what they did was they printed money instead, and the government printed money to buy the war bonds. So sort of like similar, right now the Federal Reserve is buying 1/3 of US bonds. They printed money to buy the bonds. So, like nominally it has something to do with bonds, but, in the end, it's really just printing money to spend, okay? And so printing money to spend, obviously it can it is something which can be done. And the question is what are the consequences, and how do you know what the consequences are going to be? And also, sort of, what are the causes that, so what are there's other aspects of the picture here, which is that let's see, to try to keep it short. I would argue that Weimar Germany, and to some degree the US currently, they tend to, in these situations where, with high inequality, so empirically they both have high inequality, and you end up with, lots of capital in the hands of the capitalists. And then you have the government. The government is a third party here. It's not in the picture. It's a third party. An effective government will sort of tax money, and they will be able to tax from the capitalists. But one thing that can happen in these high inequality situations is that the government basically loses the ability to tax effectively. And so they have lots of spending. So the government is sort of on the hook. They spent lots of money on the war, and then they lost the war, and then the other people, they've put these big reparation demands. So they've got to somehow come up with lots of money to spend on reparations. If they could bring the money in from the capitalists, they would be able to do that. That would work. But what happened is that they were not able to do that, and instead they printed money. And then printing money, you have to ask the question, when does printing money cause inflation, and when does it not cause inflation? And generally speaking, it basically, like, to put it in a nutshell, it does not cause inflation until it does. But one of the key driving factors that you have to ask, why did the government do that? I mean, the people in government, they were not necessarily like more, they were not stupid. They were not like, stupider than you or I. And they were not, sitting there saying, let's try to wreck our economy and wreck our currency. If you look at the history of that time, you'll find that throughout Europe, it was a high inequality, low utilization period of time, similar to the current era. And you had these strains. You had the threat of communism. You had workers threatening to strike, threatening to have a revolution. And so similar to our current period, the central bank of that time, they had, sort of two untenable situations. And there are quotes from the central banker of that time in Germany, where he says, it's similar to right now. They have the double, it is that question which I asked earlier, which is, can you have both problems at the same time? And they had both problems. And the central banker is quoted from that time saying, on the one hand, we can ruin the investor, or on the other hand, we can ruin the worker. And right now, we do not have the option to ruin the worker, because the worker is going to rise up and revolt against the government. Unfortunately, we will have to ruin an investor instead. Unfortunately, despite the fact that we have inflation, we have to keep printing money. And so again, this type of a situation is that edge scenario in which Keynesian theory breaks down. So again, the idea is that you're supposed to do a Goldilocks thing, not too much, not too little. But in this situation, you had a situation where the central bank could have stopped printing money, and they could have stopped. They could have been hard about that, and then they would have to figure out what to do about that. Maybe they would have had to go back to the victors earlier and say, sorry, we don't have the money. Maybe they would have had to figure out how to tax the wealthy. But the point is, you can change the amount of stimulus, but what happens is that the reason you cannot reduce the stimulus is because, similar to the current era, they were afraid that if they reduce the stimulus and they let the economy fall, the workers would revolt. And the question again is, why would you have this situation where you have two problems at the same time? You have both inflation, at the same time the workers for some reason have no money. Why would you do that? Why would that happen? And the reason is that you are printing lots of money, but essentially the money is not going to the worker consumer. There's no such thing as having too much money in the economy. So in Japan, they have like enormous, like trillions and quadrillions of money and debt in yen, and it doesn't matter. The only thing that happens is that instead of paying $1 for a candy bar, you pay 1,000 yen for a candy bar. So you can have 1,000 times as much currency. It doesn't necessarily make a difference in the economy because you can always just add zeros to any price. But the thing that makes a difference in the actual dynamics of the economy is the distribution. And when you have this high distribution, on the capitalist side, and you have this, the capital has nowhere to go, then you have that risk of type 2 inflation. And more importantly, because the central bank ends up, in this sort of false dilemma where, it doesn't seem to make sense for them to reduce stimulus because the economy is not doing well, and the workers not doing well, and it doesn't make sense for them to increase stimulus. And they sort of try to ride that edge, but ultimately they are doomed to fall off the edge. And the reason they're doomed to fall off the edge is because of capital consumption imbalance, which is driving the entire dynamic.
All right.
Yeah. So, I mean, we're at time, so I'll say officially, I guess we'll end the meeting here, but, I'm happy to stay on, and everybody's welcome to stay on, and we can continue to chat. Josh, I don't know if I answered your questions very well. It's
well, I'm going to just, I got about 5 minutes that I can stay with you here. So,
Yep.
I think, I think Brian probably invited me here to sort of provide something of a devil's advocate perspective on
that's great.
your group and your presentation. And the only thing that I would say is that we didn't touch on universal basic income really at all. And so I would say that maybe this kind of presentation is kind of a tar pit if your agenda is to promote the concept of UBI, because a pretty simple question kind of derails the whole conversation, and that's kind of what happened with my question. As a result of one question, we ended up not talking about the main subject.
It's certainly not the simplest way to promote UBI, and it's certainly not for everybody. Probably 80-90% are not going to be interested in the economics behind it. However, I would argue that the economics behind it are actually very strong, and it is worth going through that, despite the fact that it takes time and energy, and not everyone will be interested. There's a thing that a question that comes to my mind, which is that you mentioned, sort of this universal explanation for the Weimar inflation. So that is because reparations. So, again, I would say that reparations are definitely a factor, but to really understand the inflation, you have to be able to go in a causal, in a detailed causal mechanism from reparations and very high government spending, which is required due to reparations, to inflation. And that is, you would have to explain how those two things are related. And from CCT, I think that you can explain. I would argue that most economists cannot explain very well what the causal linkage is between very high levels of reparation and hyperinflation. I mean, I guess you could have sort of a simple explanation where you just say, they couldn't pay it, so they had to, print lots of money. But again, that is not it. Printing the money does not allow them to pay gold marks. So it's sort of
No, but printing the money allows them to buy all of the real assets in the economy and then deliver those real assets. I don't think that I'm not sure about this, but my recollection is that the payments were not only in the form of gold, that they were also in the form of real assets like train cars and ore deposits. And so if you need to mobilize the real assets present in an economy, then printing the domestic currency would be a way to do that.
Right. So I would argue that printing the domestic currency is sort of a really terrible and ineffective way to do that. I mean, if what you need is the real assets, you can just pass a law and say, because we need to pay reparations, we have a 90% tax on all real assets. So please turn in your real assets and we'll pay you 10% of the value in and you can maybe you could print the 10%. That would be much better than just simply printing. Simply printing is actually ineffective. On the other hand, you have an economy, you have real economy, you have real assets, and there is not a hard reason that you need to print currency to access these. And printing currencies is actually not a good, not an effective way to access that. And so the question is essentially, why did they do what they did? And I would argue that they did what they did for the same reason, essentially, that the Federal Reserve is actually like a little bit stuck right now, which is that they were doing the same thing, which is, they were thinking in terms of stimulus or no stimulus, and they didn't have a good answer, and they said, given that the workers are on the street, we should have stimulus rather than no stimulus, and that didn't work very well. I would argue that what would work is that, because right now, the Federal Reserve, and also true of Weimar Germany, most of that stimulus went to the upper class. What you need to do is actually to change the direction of that stimulus hose, where it goes directly to the consumer worker instead of to the capitalist. If anything, you could actually withdraw money from the financial markets. So, during the Weimar Germany, what they should have done is they should have printed money, given it out to people as a UBI, and at the same time, they should have raised interest rates way up, and they should have raised taxes way up. And that would have actually worked really well. Reparations, given that they didn't end up paying at the end, they might have paid more. The problem, maybe they would not have been able to pay all of them no matter what they did, but they did not actually have to wreck their economy, and wrecking their economy did not actually accomplish their goals. And they're not stupid people, and it's worth looking at why they thought they had to do what they did. Yeah.
Well, I think the long and short of it is that they were put in a completely impossible situation. And Keynes actually wrote a book making that argument called The Economic Consequences of Peace, which in my opinion was one of the most prophetic economics books ever written, because he was there. He was party to the negotiations of the Treaty of Versailles, and he saw that what was being done was impossible. And he laid it out all in granular detail, saying this cannot possibly work.
Yeah.
So yeah, there was no solution. But again, just because I really have to go. I would just reiterate that I don't know if this kind of conversation even is worthwhile in terms of making the case for UBI, because it's so complex and it's so easy to get caught up in this kind of conversation where we're never going to arrive at a conclusive answer, and we're going to spend a lot of time kind of on a tangent that does not promote the cause that you all are here to promote.
I think that economics in general, as it's practiced currently, is basically a waste of time. And economics needs to be strongly reformed, and we need to make it more scientific, and we need to just cut down on the the sort of the turning of economics into political discussion where three different parties have three different ideologies, and in a million years they're never going to change their ideology, and we need to make it scientific where a hypothesis requires evidence, et cetera, et cetera. Yeah, go ahead. You've got to go.
I know you got to run.
Thanks for coming, and I for one would hope that would be very happy if you come again. But so thanks for coming today.
Yeah, we'll focus. But the final thought is, right, wasn't there an alternative in World War I? Like what we did in World War II with the Marshall Plan? Wasn't that Keynes' proposition, was help Germany rebuild itself after World War I to avoid all that?
Yeah, there are many alternatives. I mean, Germany could have just said, sorry, we don't have the money. We don't have the money and we can't pay you. Russia did that in 97, and the South American countries did that. And during the the crisis, they said, sorry, we don't have the money. Can't pay you.
Yeah.
But yeah.
All right. Well, thank you guys for inviting me. Brian, it was good to see you. Eddie, nice to meet you, and be in touch.
Nice to meet you too, Josh.
Have a good night.
All right. Take care.
Well, I guess we didn't really cover UBI. Kevin sent me a direct message before he left a few minutes ago. He's like, yeah, this is too far in the economic weeds for me. I'm affected by, but find it hard to listen to, detailed economic theory. Even Economics 101 was the most boring classes I can recall. But he says he'll do some more UBI texting in the next couple of days.
Oh, Kevin was the other guy in the chat. The other guy, yeah. I saw the other guy. Yeah.
Yeah, I don't remember if you met him doing the UBI texting one time. He's in Western North Carolina.
I don't think I met him. We did one where Chris Hatton, is that his name? Chris Hatton came. Yeah.
Yeah. So he's a big forward, UBI. He's a big UBI guy. But so yeah. Maybe we can limit the economic theory to like the first third of the meeting or something like that. Try and do more, open it up more for more discussion and UBI stuff.
Yeah, I mean, whatever people want. From my side, I'm focused on theory. I think the theory needs to be spread. I think economics needs to be reformed. I'm interested in this stuff, but
I hear you. Yeah. Well, I guess that's perfect for the CCT channel, right?
Yeah.
But I've been promoting this as, hey, come talk about UBI and the proposal for Treasury dollar bills and so on and so on.
Okay.
Hey, TC.
Yeah, I don't know. I mean, to me, the economics is the interesting stuff, and it's a long explanation for a very simple answer. Like the punchline is, give people money. That's it. That's all I have to say about the solution. I mean, there are a number of different ways you could do it. You could do it through treasury dollar bills. You could raise taxes. We could talk about that stuff. I have opinions about that. But at the end of the day, it doesn't matter how you do it, but just give people money.
So you're but it does matter how you do it, whether you just print it all or whether you tax it or whether you borrow it or whatever, right? It does matter.
Some details of it matter, but at the very end of the day, if you correct the distribution of income, then everything will be good. And it doesn't, and you could do that. You could actually do that entirely in negative fashion. And if you just simply taxed away like all of the income of the wealthy, then you would probably get deflation, and you would get deflation until real wages rise. And you could actually correct the economy purely through taxation without sending money out. But sending money out is probably the easier way to do it. The only thing that you have to avoid is having these artificial constrictions where you say that we cannot afford UBI because we don't have enough taxes coming in. And you have to realize that is a false restriction, false constraint.
I guess it depends on the level of UBI, because that can be a real constraint, right? If you wanted to do $100 a month UBI, then there'd be no restriction. But if you wanted to, you did something.
It can never be a real constraint directly. No matter how little or how much UBI you put out, you always have three options. One option is create the money, such as with the treasury dollar bills. The other option is to tax the money. And the third option is to borrow the money. Those are always the three options. And you can do, any level of the three. The second one is sort of not naturally sustainable. It could actually potentially be sustainable, but it makes the accounting very weird.
Sorry, what were they? What were your? How did you count those again? The taxing, creating, borrowing.
Yes, those are the three options. That's it. No more, no less. And creating money is the only one where you change the money supply. And again, the money supply, you can increase it, but you don't have to. You could actually decrease the money supply by taxing all the income away from the wealthy, and then you would fix the problem by decreasing the money supply on the right-hand side. You can fix the problem by decreasing the money supply and then income supply on the right-hand side with the capitalist, or you can fix it by increasing the income supply on the left-hand side with the worker and consumer. Both actually work. But probably the UBI is sort of like more politically feasible. Yeah. But you should increase taxes also at the same time as much as you can. And borrowing, I would actually argue for the opposite. I would argue that the government is actually exposing a vulnerability when they borrow too much. And they should actually do the opposite. They should actually bring in more taxes and pay back the debt at the same time that they're paying out the UBI.
All right. Well, thanks for hosting this tonight, Eddie.
Yeah, no problem. No problem.
You're still recording, Eddie?
Yeah, I kind of like the transition party. And I'm not sure if what Seth meant was that transition has a particular meaning with trans Americans. So
Well, I meant that I made a channel for it,
yeah,
and then it didn't need to be the title anymore.
yeah.
It has its own channel now.
I mean, Brian has the Phoenix Congress and the idea of coming through the cycle and rising from the ashes. So I mean, I do agree definitely that that's sort of where we are. We're going through the cycle, and hopefully, not hopefully, I mean, we will. I mean, I think that probably we'll get through it. I'm not going to go extinct. And I think that we're actually doing slightly better than we were doing 80 years ago. So cautiously optimistic.
Why do you say that? 80 years ago, you had actual political choice, right? You had the Republicans who were like, let's do nothing and the economy will work itself out. And then you had FDR who said, we're going to do something and we're going to try a bunch of different things. And if things don't work, then we'll try something different, but we're just not going to accept the status quo. But today we don't have that.
Yeah.
So why do you think we're better off? I'm curious.
Well, I think we're slightly better off because, we did manage to kick Trump out in 2020. So the Trumpist fascist thing has not won yet, but it's also not dead yet. Russia sort of, if you analogize that to 1940s Germany, it's like they went into Poland, and instead of like taking Poland over in the course of 2 weeks, they went in and the Polish like kicked them back out of the country essentially. And then they were like, I mean, that's going to not be good for Putin in Russia. He's sort of, going to be in a bad place. China is not sticking out their hand. They're not saying like, yeah, rah rah, Russia, invasion type stuff. They're saying, they're sort of staying moderate. So I'm glad that China has not gotten that the world, the polarization of the entire world, as it happened in 1940s between fascism, liberal democracies, and communism. Right now, that those lines have not yet become very clear. Like, it would seem that China and Russia are on one side opposite the West, but China is not really going all the way towards Russia. It's not being like Japan and Italy. It is not doing its own wars of invasion. It's trying, China is doing its best to like sort of
They're
like
doing
get
that
Europe,
road,
get
doing that
Europe
road
back on their
trip.
side. Yeah, get Europe back on their side, get the rest of the world, get the rest of the
Right.
world on their side, and not end up being sort of the big enemy for the West to fight against. So that's I think that from that perspective, we're doing a little bit better than we were.
So help me with my
during World War
facts
II.
here. I'm thinking that we put sanctions on Russia so that the people would turn against Putin. And I think the people rallied around Putin. Am I wrong?
I think it's always going to be hard to say. I mean, there's definitely some on both sides. I mean, it's like there's some people in the US who support Trump. There's some both people who are very opposed to
Okay,
him.
I get that. It would be like a
Russia, same
Trump
thing.
rally.
But the thing is that in Russia, it's very like they put people in jail, and Putin like assassinates journalists, and they like there's a high cost. I would
Like Assange, Julian Assange. And,
Yeah, Assange, you got Assange too. But I mean, I live in China. Like, I would say that Russia, it is different from it is worse in the West. I would suspect in Russia. I know in China that it's different, and you don't go out on the streets and proclaim that the government is wrong in XYZ
okay.
ways.
You
Um,
watch, yeah, okay.
there's like some state suppression of dissent going on there. US, it does have its own version, but it's different.
And then I was thinking that we did the sanctions so that we could isolate Russia. And then we ended up kind of isolated ourselves. And all the other countries started swapping their money back and forth. And Russia demanded rubles for its oil, and China's using its currency for trying to take over the global currency market.
What I've seen is that China is more or less actually like sort of like complying a little bit or getting it out of the way. They're not trying to resist the sanctions. They're more or less being in compliance for the most
Oh,
part, which is super interesting because I think that tells you what their stance is. That essentially they're saying that despite Russia being their ally for the last 10 years or whatever, they are not in this fight. They are more or less neutral in this struggle between Russia and the West.
anyway,
Or Russia and
I
Ukraine.
had this fantasy of we're turning into the gang that couldn't shoot straight. And it's like we're just headed down. I mean,
Yeah,
it's
I mean, yeah, the US has its problems. Russia has its
yeah,
problems.
I don't compare them. I just live here, so I only know about this one.
Yeah.
Anyway, cool dudes. That was some meeting you guys had. You went for it, Eddie.
Yeah.
Yeah, you carried the ball.
Yeah.
You know your business.
um yeah, I don't know. I wish I could be more effective at converting people who are sort of like, intellectually interested in economics. Um, I mean, he didn't really have much chance to talk too much.
What happened with that meeting with Jamin and the Friday night economics meeting?
There was like some talks, like somebody said like they should get some sort of approval or something, and so it's sort of trailed off with the economic circle. Yeah, it's sort of
So
trailed
was
off.
it coming out of the United People's Assembly as a circle from them? Because they have a lot of rules. I go to their meetings and they spend a lot of time talking about their rules or their
Yeah, yeah,
charter or whatever it is. And it's
yeah,
like,
yeah,
luckily, we stay small and we don't have those problems.
yeah. Yeah, I think it's really easy, and you got to be careful not to end up overburdening yourselves with figuring out how the group works, because it can be a distraction.
Right. So this week we're going to have a good meeting on Wednesday. I got the agenda all lined up. It's all going to be all videos, so it's going to go slicker and slicker as it can be.
Do you hear anything back from any of those, the emails you sent out?
Not yet, but I did find out that I did send them on my cox.net. So that
AC,
problem I had is not it.
I'm gonna stop the recording.
Yeah, please.